Hi everyone, my name is Josephine. Welcome to this channel and thank you for being here. Today we're going to tackle a critical but often overlooked process, the audit of wealth management. Whether you're an individual investor, a family office executive, or a trustee, understanding how to conduct a rigorous audit is your most powerful tool for protecting capital, ensuring alignment, and validating trust. Think of it not as an act of distrust, but as the highest form of financial stewardship. Over the next couple of minutes, I will provide you with an actionable framework. Here's our agenda. First, we will define why an audit is necessary and set its core objectives. Second, and this is the heart of the talk, we will dive deep into the four pillars of a wealth management audit: the fiduciary audit, the financial audit, the investment audit, and the service audit. Third, we will highlight major red flags, the clear warning signs you must not ignore. And finally, we will conclude with key takeaways and a path forward. Let's start. So, why audit? The wealth management relationship is complex, layered with fees, strategies, and products. Without a structured review, you operate on assumptions. An audit moves you from assumption to evidence. There are typically three contexts. 1. The personal or family audit. This is you asking, am I getting what I paid for? Are my assets safe? Does my portfolio truly reflect my goals? It's about accountability and value. 2. The institutional or internal audit, conducted by a family office or institution overseeing external managers. The question here is, are our advisors complying with our mandate, with regulations, and acting in our best interest? And 3. The forensic or dispute audit. This is reactive, often involving legal counsel. The question is direct. Has there been misconduct, negligence, or fraud? For today, our focus is on the first two, the proactive, stewardship-driven audits. The goal is not to find a problem, but to confirm a healthy, transparent relationship, or to discover one that needs correction. The required mindset is that of a skeptical detective and a prudent steward. Follow the documents, follow the money, and verify everything. This framework is your blueprint. We examine the relationship and the assets through four distinct but connected lenses. Here, you audit the rules of the engagement. Start with the Investment Policy Statement, or IPS. This is the governing constitution for your portfolio. Does it exist? Is it detailed? Does it clearly state your risk tolerance, goals, and constraints? Most importantly, is the manager actually following it? A deviation without approval is a major red flag. Next, clarify the legal duty. Is your advisor a fiduciary, legally bound to put your interests first at all times, or are they held to a lower suitability standard? You must get this status in writing. Then, go to the disclosure documents. What other businesses do they run? How do they get paid beyond your fee? Finally, review the management agreement itself. Understand the termination rights, the grant of discretionary authority, and the exact fee calculation formula. Pillar 2. The financial and performance audit. This is about the numbers. We break this into three parts: fees, performance, and custody. First, fee transparency. Your goal is to map the entire fee stack. There's the obvious advisory fee, but underneath, mutual fund expense ratios, ETF costs, trading commissions, wrap fees, and hidden costs from structured products or private investments. You must calculate the all-in fee percentage, total annual dollars paid divided by total portfolio value. This is your true cost. Second, performance analysis. This must be done on a net of fees basis. Then, you benchmark. Compare your portfolio's return to an appropriate benchmark, not just the S&P 500. A balanced portfolio should be compared to a blended benchmark, like 60% global equities, 40% global bonds. Look at rolling 3-year and 5-year periods. Ask for GIPS, compliant performance reports if available. They have strict verification rules. Also, consider risk-adjusted returns. Did you get enough return for the volatility you endured? The Sharpe ratio is a simple metric to gauge this. Third, and this is non-negotiable, asset verification and custody. The gold standard is an independent, major custodian. Names like Charles Schwab, Fidelity, Pershing, or Morgan Stanley. You must receive statements directly from this custodian, not just repackaged reports from your advisor. Reconcile them. Ensure assets are registered correctly, in your name, for your benefit. This separates asset management from asset holding, a fundamental safeguard. Pillar 3. The Investment and Strategy Audit. This assesses the what and the why. Look at asset allocation. Does it match the IPS? Has there been style drift? Evaluate portfolio construction. Is it properly diversified or overconcentrated in a single stock, sector, or illiquid product? Are complex products like non-traded REITs or private funds suitable for your liquidity needs and understood by you? Examine tax efficiency. For taxable accounts, is there evidence of tax loss harvesting? Are investments located wisely? Tax-inefficient bonds in tax-deferred accounts? Equities in taxable? Review trading activity. Look for patterns of excessive trading or churning, which generates commissions. Conversely, reverse churning is paying a high wrap fee for an inactive account. Pillar 4. The Service and Operational Audit. This is about the human element. Review the quality and frequency of reporting. Are statements clear? Do they include easy-to-understand performance attribution? Verify your advisor's credentials, CFP, CFA, and check their public record. And a crucial, often missed question: what is the succession plan? If your primary advisor retires or is unavailable, who takes over? Is the service model institutional or dependent on a single individual? Let's crystallize some of the most critical red flags. If you see these, it's time for a very serious conversation. Number 1. Inability to explain fees or strategy in clear, simple language. Obfuscation is a defense mechanism. Number 2. Performance reports that lack a benchmark comparison or constantly change the benchmark. Number 3. Pressure to concentrate assets in a single proprietary product that offers the advisor a higher payout. Number 4. Statements that do not come from a well-known independent custodian. This is among the highest risk scenarios. Number 5. Consistent, unexplained underperformance against a simple, appropriate benchmark after all fees are accounted for. And number 6. Defensiveness or hostility when you ask detailed questions. A transparent advisor welcomes due diligence. So, what are your actionable steps? Step 1. Gather. Collect every document: IPS, ADV, contracts, custodial statements, tax forms. Step 2. Map. Create a spreadsheet of every single fee. Step 3. Calculate. Determine your all-in cost. Step 4. Benchmark. Use tools like Portfolio Visualizer for a neutral analysis. Step 5. Verify. Confirm assets directly with the custodian. Step 6. Interview. Have a meeting with your advisor, present your findings. Their reaction will be telling. And Step 7, if needed, engage a fee-only hourly consultant for an independent second opinion. This is often the best investment you can make. To conclude, auditing wealth management is not a one-time event. It is a disciplined, periodic practice, ideally conducted annually. It transforms the client-advisor relationship from passive trust to informed partnership. You are not auditing to micromanage, but to validate that the strategy, execution, and costs are aligned with your life goals. Remember the core principles. Governance first. Without a clear IPS and fiduciary duty, you are building on sand. Follow the money, to the fee, to the performance, and crucially, to the independent custodian. Look under the hood. Understand what you own and why you own it. Verify the people, credentials, history, and their plan for the future. The ultimate goal of this audit is peace of mind. The confidence that comes from knowing your wealth is not just being managed, but is being stewarded with competence, transparency, and in your sole interest. That brings us to the end of the sharing session. I hope this framework empowers you to take a more active, informed role in overseeing your wealth or the wealth entrusted to you. Thank you for your attention. If you found this channel is useful, please do subscribe and share it out with your friends, colleagues. Thanks again for your support, and have a great day ahead.